Are we facing in the next days a new buying opportunity for the S&P 500? We should remember that 2 months ago, we mentioned these different paths, the green and the red path. And a month before, we just mentioned that if there was a buying opportunity on a pullback in September, this buying opportunity could occur at 29.50 or a bit lower, but above 28.25, 28.50, which was about the bottom of the rising red triangle that we see here. And in fact, we had from the mid-September a pullback, and now we are back to the top of the triangle. And if we zoom up a little bit, we notice that this is the third time after July, August, September, the second time, and now we are in October and the third time at the top of the triangle near 3,000. And the question is, can we be facing a dip as the short-term oscillators is relatively overbought? So it could be a minor dip around 25.50, 25.25 at most, and then back up along the seasonality, yearly seasonality, November, December, January, February, and so on. We noticed that there was a big rotation in the market already last month, and that scenario is going to assert itself more and more. Here we have the black line on the bottom part is the ratio of growth stocks versus value stocks. And we see that growth stocks during all of 2019 have been moving up, and now they are breaking their uptrend. On the top part, we have the S&P 500, so you recognize the triangle shape currently present. Clearly, here, the ratio is making lower highs and about to make lower lows with a downside declining momentum. And that means that growth is now a little bit underperforming value stock. What has for implication for the US market? One of the things is, of course, the relationship between financials and utilities. Here you have the black line, and in green you have the direction of interest rates. And you see how amazing that this black line is making a double bottom right now, at the same time as US interest rates are also making a double bottom. What is interesting is that here we compare financial versus utilities. Both are related to the interest rates environment, of course. And if they are making a bottom here, a double bottom, which is not yet activated, that means that the relative strength of utility is going to slow down because utility are overowned and they have been progressing very fast on the way up. Here we see the orange dotted trend line. On the contrary, financials have been in the kind of a downtrend and are now bottoming. So we see that this relative strength versus the S&P 500 is confirming this rotation out of utilities into financials, and that makes sense because financials are benefiting from higher long-term rates, so a steepening of the yield curve. And we see here a potential double bottom for the US interest rate in the black line here. So there is another sector on the value area which could benefit. This is industrial. It has been battered by the trade war, and we see here the relationship between industrial versus discretionary. Within that discretionary sector, there are growth stocks, important growth stocks. And we see that has been in a downtrend, and it's also in the bottoming process. So industrial, as a part of value type of stocks, could be benefiting and could stop their underperformance. We see that industrials, the relative strength here in orange, again, is within a small triangle and is trying to push higher. And if it does, then we see also that the next dip which could be coming could be a small opportunity to buy that future outperforming sector. industrial, in financials. You see that to remain within a triangle, we need the big leaders to kind of stall at the top of the trending range. That means that the relative strength of technology, for example, should be stalling and pulling back horizontally or eventually made a very slight decline. Not putting in question the long-term uptrend, but certainly stalling and allowing the S&P 500 to remain within its range below its resistance back to the middle of its triangle. And for that, when we discuss about the growth and towards out of growth into value rotation, we should remember that it was a global view, including all indices on a worldwide basis. And we see also that there are in Europe quite a few value stocks, and that's a reason why the relative strength of, for example, here, this ETF Euro ex-UK and ex-Switzerland is trying to bottom and rising in the recent past days and weeks. So Europe is outperforming the S&P. Also, Japan is a little bit outperforming the S&P. We have that information here with the dotted trend line here on the top part of the panels, rising, making higher highs and higher lows. It's also helped, of course, by the yen index here, which is declining a little bit in value, and that helps also the Nikkei, which has here a relatively bullish pattern. It broke a descending trend line, pulled back on it, and is moving higher. It could stall a little bit, but any pullback should hold above the cloud. And finally, the emerging market, which are a little bit lagging, but still making the same process of a bottoming relative strength versus the S&P 500. You see here the orange trend line, dotted line, and the pattern is a bit less bullish. We see we're still within the triangle and not above it like for the Nikkei. So short term, what are we looking for if we expect a small pullback? Well, what we should look for is possibly on the currency side, which react very fast, a move up of the yen a little bit, which is within its downtrend. And for the Euro-Swiss, a little pullback, that means a strengthening of the Swiss francs before it resumes its uptrend and before it activates a double bottom. So stronger yen, stronger Swiss francs could just correlate with a short-term period risk off, meaning that there is a little pullback within our triangle. And that's what we are going to monitor in the coming days. So this is the scenario, and we'll talk to you next 2 weeks.